Welcome to the Family Business Audiocast. I am R. Adam Smith, creator of this series, and a warm thank you to our live audience today and for those listening later. On this episode of the Family Business Audiocast, I'm joined by John Koeppel, partner and private equity independent sponsor leader at Lippis Matthias, LLP. John is one of the foremost legal advisors in the independent sponsor and private equity ecosystem. Great to have you here today.
Great to be here. I'm excited to chat for the next bit on family offices and direct deals. It's going to be great.
Great. I'll talk about you briefly, then we'll dig in. John is one of the foremost legal advisors in the independent sponsor and private equity ecosystem. He has structured, negotiated, and closed 250 transactions across the space, including family offices, private equity, and independent sponsors, as well as strategic buyers. With more than 2 decades of experience as a corporate deal attorney, John leads the Lippis Matthias private equity and independent sponsor practice. He has offices in Buffalo and Tampa. And nationally, he counsels buyers and sellers, of course, on M&A, as well as some capital formation. And he's known for a pragmatic, results-focused approach to these complex small and mid-cap transactions. Before Lippis, he was at Nixon Peabody for 17 years. Lippis is a U.S. business law firm with over 200 attorneys across the country and multiple offices. It's recognized for its strength in private equity and corporate and finance, as well as family office advisory services. John will talk about that on the call as well. Today, we'll unpack how independent sponsors, independent deals are in fact reshaping private markets. Independent sponsor transactions or fundless sponsor transactions is an area of expertise for mine going back to 2002, an area I have passion, and I was one of the leading leaders in this space nationally. So it's great to talk about it again as the industry has expanded dramatically. We'll also talk about why this direct deal making has become a next frontier in private equity. So John, just tell us a little bit more about your role there and we'll just jump in.
Thanks, Adam. Yeah, I've been at the firm for over a decade now. We've kind of grown the practice and focus our client base looks and feels like a lot of your audience, family offices, independent sponsors, those making direct deal investments. And it's a great space. As we all know, it's this direct deal market, especially in this lower middle market, is very active. So excited to look forward to some of the things we're going to dive into today.
Great. So today, who are independent sponsors and why is this important now? I'd like to hear from you on framing the sponsor model and just talking about what that term means and then contrasting that, of course, with a private equity fund, but then also maybe contrast it back to the original search fund model, which was defined by Stanford Business School back in the 80s.
Sure. Yeah. As we look across our client base and on the independent sponsor side, really to kind of group them into two buckets, we see a lot of former private equity sort of investment banking consulting types who either were frustrated and or saw an opportunity to kind of start up their own firm. The other model we often see is the operator executive, someone who's done something very successfully in an industry, perhaps working for a portfolio company backed by private equity and now wants to do it on their own. And I think what's happened, I mean, I've been doing these types of transactions as long ago as 27 years ago when I was a young associate, and it was almost called late 90s fundless sponsor transactions. But now there's an entire ecosystem of events, podcasts like this, capital partners, SBICs who support these deals. And so, because of the attractiveness of these companies, the number of opportunities, and literally the entire ecosystem that's supporting them, we're just seeing a much, much higher use of these types of models. And they have some strategic advantages over traditional private equity funds, which we're going to get into today. And I think your last point, Adam, was how do I compare and contrast these with sort of the search model? We have some of those types of clients. I often think of the search model as almost someone who's buying themselves a job, maybe a smaller business. They're going to buy a small plumbing business and they're going to take out an SBA guaranteed loan. Those are certainly good, valuable transactions in the economy. The independent sponsor transactions are really transactions that a strategic or a larger fund could do, with the biggest distinction being they don't yet have the capital to close on the transaction. That's something that comes apart as part of the deal.
Mm-hmm. Let's talk a bit more about the flexibility. I had led 14 SPVs myself previously, and that included 10 buyouts. And part of that included a lot of investor conversations at the GP level, not just the LP level, and discussing different structures. So there is complexity, of course, in structuring the deals, but there's also greater flexibility that facilitates the deal actually getting done with the capital partners, and not to mention the seller. Talk a bit about that flexibility, which is also relevant to the family office backer or sponsor as well.
It's a great point, Adam. And it's probably one of the biggest advantages. I often get asked by our independent sponsor clients, why do they win deals, especially if you're comparing and contrasting them versus, say, a strategic who's looking at buying a business. And it's that flexibility with the target in terms of rollover equity, deferred consideration, earnouts, things like that. And then also, to your point, the beauty of the independent sponsor model is, you can do deals in different verticals, large deals, small deals, different investors, and so long as you have attractive opportunities with the right expertise around the table, you can sort of structure win-win transactions, including one of the most common things we've been doing, and even more so since the tax law got better in July, is something called QSBS, qualified small business stock, where there can be potential substantial capital gains tax advantages to investors in these deals. So one of the biggest advantages of these transactions is the flexibility they offer in structuring.
We can dig in a bit more there throughout the call. I think it's important for deal makers as the GP and the LP and the seller to really think about this flexibility and be collaborative in getting a deal done. So we see, obviously, I've advised on hundreds of company transactions, private company transactions in an M&A context and private equity context, and I'm seeing this meaningful expansion in direct deal making, which goes beyond the traditional private equity fund between family offices or super entrepreneurs may not have a family office, but it's similar. And then the sponsor of a deal. So can you just talk about that sort of the landscape on the seller side, the succession planning opportunity for family held businesses, and then on the money side is the desire for transparency, getting into the weeds. The sponsor backer, let's say a family office, is going to have more transparency because the sponsor is going to do a lot more work than a private company itself if they don't have an investment banker, which gets back to the whole point, which is a lot of these deals are happening without investment banks.
That's right. Great point. And I think what, many of the independent sponsor transactions we've seen work on, which I would say are, on the low end, maybe 10 million of enterprise value up to 100. We certainly see deals over 100 million of EV value in this space, but not as many as you would suspect. And it's often the independent sponsor he's identified that company, usually on a proprietary basis. They're not on the market, or if there is a banker, it tends to be more of a Main Street banker, maybe a regional banker, not as broad of a process. They're building a relationship with that business owner. They're selling them on the grander vision. Hey, you can take some chips off the table, and you have a smart, capitalized partner to help you continue to scale, right? So that can be very attractive to a business owner. And then from the family office perspective, listen, there's certainly some advantage to investing in traditional committed funds, and family offices have and will continue to do that. There's a lot of advantages to direct deal investing in terms of, lower fees, actually seeing a single opportunity. You're going to see the full book on that opportunity, the model. You're going to live it, you're going to taste it, you're going to breathe it. Depending upon the size of your check vis-a-vis the family office to the deal, you may have a board seat, you'll have other governance and protection rights. So it allows you to have a ton of information, and not least shocking thing we're going to hear on this podcast today, many of the family offices and other investors who invest in these deals tend to invest in the industries and deals they've done well in before, right? So you have that dynamic going on as well.
Let's talk a bit about that platform building. One of the most important areas of the family office industry, which I speak about often on my podcast and just spoke about it again this week with Henry Geisens, who's the co-head of the family office practice at Denton's, which is the largest law firm in the world, talked about this, let's say, platform building. So from a lawyer's perspective, please talk about this platform building, which includes roll-ups and tuck-ins, consolidations, but really more platform. I like to use the word platform
Right.
building, enterprise building for wealth creation. It's having been in 3 private equity platforms, there is value to platform building, but there are limitations to the private equity model for platform building, pros and cons, versus platform building from the family office perspective, like a Pritzker, Heritage, or Iconic, or Perot, or what have you. So since we're talking about flexibility, and then we'll talk next about financing, like
Sure.
the platform building is really interesting to me, and I think especially when you consider the 3 different parties at the table. There's the seller, the entrepreneur, then there's
Yep.
the sponsor that might have like a 7-year horizon, and then there's the money that also could have a longer term horizon, and that all drives into the IRR versus ROI equation.
100%. I think the platform building is key, and some of the most successful independent sponsor transactions I've seen in my career have been that where you have a seller who's built an amazing business, often taken it from zero to some threshold, is sort of tapped out at that stage, doesn't either have the capital or the wherewithal or the experience and how to scale it beyond that. Along comes an independent sponsor who's bringing his or her pedigree along with their operating partner and advisors, perhaps along with some smart family office capital, and then can go build out a strategy of, okay, great, here's how we might grow organically, and more importantly, here's how we're going to go do tuck-ins, right? And I think we're all familiar on this podcast with the concept of multiple arbitrage, right? That's a component of this, adding more scale, buying things at 2, 3, 4, 5 of EBITDA, growing them to 10, 15, 20 of EBITDA, getting higher multiples, because as we all know, once that platform has been scaled, there is a whole nother larger audience of strategics and larger private equity that would love to buy that business post scale. They have zero, if any, interest in that $3 to $5 million EBITDA company, which is operating on QuickBooks and is going to need several years of someone rolling up their sleeves to professionalize that business and do the dirty work of those smaller add-ons and integrate them. So that is a tremendous value add that a successful independent sponsor with the right folks around the table can do.
On the tax side, talk a bit about the dynamic of long-term capital gains right now. What's happening with the recent tax rulings, and how is that relevant? How is it different than the past?
There is a rule that's been in the books for a long time, but we continue to see it used more and more under Section 1202 of the code, also known as QSBS or Qualified Small Business Stock. If you buy or invest in a business which has less than $75 million of value of tangible assets, you have to structure it as a C Corp. There's a couple of industries that are excluded, but many industries qualify. And on a certain hold period, a minimum of 3 years, the highest benefit is 5 years. When you go to sell the stock of that C Corp, you are going to be able to eliminate most, potentially all of your federal capital gains tax. And the majority of states also opt into this program. So there are a lot of efficiencies from a tax structuring perspective. There are things you can do on a flow through structure with depreciation and losses where you can analyze those structures as well. But the government and our tax plan, as always has been the case, continues to incentivize the growth of small to mid-sized companies. And this qualified small business stock is something that I'd say on probably 70 to 80% of the deals we're working on right now, people are using.
Wow. And what was that number a couple of years ago?
Probably before zero, before 2017, 2018, when C Corp rates were so high. And then I'd say it's taken a few years for word to get out about the program and how to structure it. So maybe we were seeing 30 to 40%, but since the new changes in July one of the negatives of the old program was it had to be a 5-year hold. One of the new and improved program at 3 years, you get a 50% reduction in your taxes. At a 4-year hold, you get a 75% reduction. So that's great because now all of a sudden it doesn't necessarily have to be a 5-year hold, right? And there's some technical rules on potential rollovers which may mitigate that. But I think, like anything in life, as more and more people understand the value of the program and its pros and cons, they're like, yeah, this is the game changer too on a tax advantage basis in terms of what my after tax return may be on a future exit.
Okay, sounds good. So, family offices and entrepreneurs that want to buy private companies that are outside of auction or busted auction, or working with a deal promoter, deal sponsor, entrepreneur, they can reach out to John on LinkedIn, John Koeppel, Koeppel, or they can reach him on the website for Lippis. I assume your website probably has some information or articles or guides or something to independent deal making as well, or you can send
It
people
does.
information.
Yep,
Yeah.
for sure.
Okay. So let's talk about how these deals are financed, the independent sponsor deals, one-off deals. So excluding the platforms, I did deals with great GP partners, and they sometimes backstopped or led the deal, obviously, for 50, 100% of these transactions, lower middle market transactions or small cap transactions. Other times I co-led them, or other times we syndicated with structured capital, structured paper, mezzanine.
Sure.
And then there's also the SBA. So why don't you walk through some of the different types of financing structures initially, and then let's talk a bit about how the economic waterfalls are created.
I think, once we start working in a transaction, one of the first questions when we're working with one of our independent sponsor clients at the front end on the letter of intent with the target is how much is the seller contributing to the deal, the value of their rollover equity, are they holding any seller financing or earnouts? That can range from deal to deal, not uncommon between rollover equity and those other components for a seller to say finance plus or minus 20% of the deal. Sometimes it's more, sometimes it's less. So once we account for sort of the seller piece of the deal, then the question is, okay, great, what's left over, right? So let's say it's a $50 million transaction. The seller in some way, shape, or form is going to roll and or hold paper on, say, 10 million of that 50. So now we have to solve for 40. I'm excluding transaction costs. So we're going to figure out at this stage is, okay, great. Where's the rest of our capital coming from? There are certainly one-stop solutions out there, whether it's a family office providing the bulk of the equity and finding some debt. SBICs are a big player in today's market and can traditionally provide the debt and either all of the equity or will co-invest equity alongside of a family office. We also see, I've got one client in particular that closes a lot of what I would call old school transactions where they get traditional senior debt, probably not a ton, maybe 2 to 2.5 times, and they backstop the rest with equity from family offices, high net worth, ultra high net worth individuals. So the beauty of an independent sponsor transaction is many of these institutional investors, like SBICs and these meds firms, they love to have family offices and other equity around the table. The one constraint of the independent sponsor model that every lender and investor asks for, okay, great, we're going to buy this business now. We'll certainly have enough capital to buy the business at close. Will we have enough capital for add-ons? What if we hit a rough spot and we need to put more capital in to support the business during a rough spot? So having sort of smart, savvy, deeper pockets around the table is really attractive to all the stakeholders.
You mentioned old school deal making. I think old school deal making was you buy a distressed company with debt and seller paper and you put $1 in. I think that's the old school.
That's right. That's right. Most banks want to see, yeah, most banks want to see maybe $2 or $3 today, but yeah, for sure, for sure.
Okay. And the relationship between the independent sponsor and the backer is really important. And that can take many months to build. Sometimes the deals don't provide for that time. So I think it's important to have long-standing relationships or go to or repeat backer because the bankers or the sellers may not have the patience or they just need to get going or they might be tempted to run a process. Just talk about that time management, relationship management element between backer and sponsor.
It's a great point, and it's one of the hardest dynamics of this space because obviously you don't already typically have the committed capital. So most of our independent sponsor clients are trying to build those relationships as soon as possible. Hello, family office, hello, capital partner. I have this great thesis to go do a roll up in cybersecurity, in healthcare, in franchise burger restaurants, whatever that thesis might be. Maybe you don't have a binding subscription agreement with a binding legal commitment to support the deal, but you have buy in where one or more investors are saying, I love it. I love the team. I love the strategy. I love that you're going to sign up these potential targets. Give me a ring back in a month, whenever, and when you have some of them signed up, and then we can go. That's a better scenario. That way, so that when that call does come in, it's not a cold call. I'm sorry, who are you again? Sometimes you don't have the benefit of all that time. And then deals come together in different ways, like they always do. Often we'll see two or three significant investors that are on the table, one of whom might already have a strong pre-existing relationship with our client, maybe from a prior deal, a prior fund, whatever, and they're like, hey, this is a $20 million check. We'll take 12 and we'll backfill in one or two of our co-investor partners from other deals to fill the rest. So it's always very, very interesting the way the sort of the cap stack comes together. Varies greatly by deal, but the compression of that time period, because the average deals we all know, you typically only have, say, plus or minus 90 days from signed LOI to close. You can sometimes get it extended a bit, but you have a relatively tight window of time where you're doing accounting, Q of E, legal confirmatory diligence, raising the debt, raising the equity. So the more you can do before that clock is ticking, the better.
Right. And that clock, in my experience from the initial discussions of a live deal to an LOI, usually, 45 to 60 days, max 75, 90. And during that time, it's really important on a profitable company to get the debt lined up. I always line my debt up first.
Yep.
Others do it different ways. But from the family office perspective, just maybe talk a bit about that lining up of the cap stack of third party tranches, and like what do you see working best in terms of timing chronology? And then also, do you see more, let's say, a faster moving sponsor moving with a family office and tapping into the family office network for their preferred lenders? And I've had some experiences where the lenders maybe needed to be moved around or changed. And there's that dynamic between speed and preferences as well from the buyer perspective.
Yeah, totally right. I mean, sometimes, as you know, of the two, relatively speaking, that the debt is typically easier to find, right? And there's everyone can look at EBITDA and figure out what sort of multiple for a business like this is appropriate. The equity is always, the harder of the two. So many of our clients will even pre-LOI get the debt read. How much debt can a business like this support? You might even get some preliminary indication of interest or term sheets from different lenders or SBICs to gauge kind of, okay, great, now I know how much debt is going to be in the cap stack. What's my equity gap? So it's definitely one way to go. We have seen it the flip of that, where we've got a client that is doing a roll up in a very very niche vertical. They found a family office who is backing them, and to your point, Adam, the family office has preferred lenders that it has dealt with before, and they are helping finance the deals. In some of these roll up strategies, what's fascinating, some of them are relatively small roll ups. I think 1-2 million of EBITDA, but we're going to go do up like 10 or 20 of them. They're just going to go do the first like half a dozen or so with all equity. And then once they have a semblance of a company that can walk and talk, has a CFO, some shared services, then they're at 5, they're at 10 of EBITDA. Okay, great. Now we can go get like real debt because we're not going to go get debt on a $1 million EBITDA business, right? So there's different ways to go about it. And I think having those conversations early with your partners around the table to figure out what makes the most sense. And to your point, sometimes you're swapping in and out groups to find out, what's the best mix for this particular deal.
Also, one thing I did, and you could do as a sponsor, is you just get the debt done with somebody that gets it going, and it's fine
Yep. Yep.
for an initial senior debt or full debt cap structure. Negotiate attractive early call redemption terms, and
Yep.
obviously cost of funds and so on. And then you can hold them in the deal for like a year or two, and then do a
That's
refi.
right. The other thing we continue to see, I'm sure you saw this back then as well, as a lot of times what I would call the incumbent bank or the incumbent lender to the target business often wants to stay, assuming things are going well, wants to stay in the deal. And typically, as you might expect, can move pretty fast and pretty aggressive because they don't want to lose the relationship or the credit. So we always recommend to all of our clients, anytime you're looking at a target, hey, what's the size and scale of the incumbent bank? Do they want to stay in? Okay, great. You should definitely get a proposal from them as well.
Let's move to sourcing. Obviously, with no deal, there's no deal. So sourcing the deal is essential. I see hundreds a year ever since I began independent sponsoring in 2002, 23 years ago. I have built a massive deal network that keeps coming in. And once it keeps coming in, it just flows, especially in the small cap space with smaller bankers and investment bankers and accountants and lawyers and so on. And there are some networks that also provide independent sponsor deals, but majority of the time they're off market. I don't think this has changed very much, but it's important to talk about it. And you're sort of in the middle of it because as a lawyer, you want to help people and you see deals and you sort of pass things around, unlike a banking model where you really want to control the deal and get paid and manage that deal process. So if you could just talk about deal sourcing and where do you think the good deals come from?
I think you nailed it. I don't know that it's changed dramatically. I think some of the best, most attractive deals I've seen our clients execute on are those that either they sourced proprietary. And yeah, listen, there's pros and cons to a proprietary deal. One is it's proprietary, meaning there's either no one or not many other folks around the hoop, so to speak. The con is the average proprietary deal. I think the last stat I saw from initial, hello, here's who I am, to closing, it can be a 9 month or longer process, as opposed to, as we all know, if there's a banker or
I had
someone
a
involved
12
that's going
month I had a 12-monther. Hmm.
Exactly. Yeah. But and those can be some of the most successful transactions, right? So as long as you're prepared for that. I think a lot of our clients are really good also, industry trade shows. I'm seeing much more from our client base today. If I were look at compare and contrast them today versus 5 years ago, much more targeted thesis. We're going after aerospace supply companies, or we're going after healthcare businesses that look like this, right? And so the beauty of that model is you can hone your talk track, whether you're approaching accountants, lawyers, regional investment banks, industry conferences, to try to find the best either proprietary or what I would call semi-proprietary deals where you come across really credible to the intermediary. And in particular, if you can meet that seller soon and put an offer in front of them soon and really prevent them from taking it to a broader process, those are the deals that we often see our independent sponsor clients win.
That's good. And then getting the first one done is the hardest, right?
There's nothing. I always tell all of our clients, like, maybe the first one isn't the most attractive. Maybe your economics with your capital partner aren't the strongest or the best you're going to get, but it is a night and day difference from closing your first deal to not. It is not for the faint of heart, but once you do, you're on the map. And whether it's additional acquisitions for that platform or potentially starting a second or other platforms, it's a game changer for sure.
Yeah, I went on to do 14 SPVs after the first one, and I did not know I would do that, but the first one was tough. And my friend Scott and others, I want to thank them for that the scrappy process we went through to close a couple $1 million in 2002. It was a long time ago.
Right.
So family offices are, including many that are building wealth in illiquid companies and, working with me in my business and consulting them on their platforms or coming on my podcast. They want well-priced, attractive private companies. Those can be tuck-ins,
Yep.
or those can be independent deals. That the platform models probably could increasingly interesting to family offices because sometimes the deals are too small.
Sure.
Maybe there is obviously the benefit of the full control in the GP LP mix. There's greater transparency, getting into the weeds on the due diligence and the QV and kind of backstopping, paying for that process. There could be a co-investment model with even some other friends of the house. Maybe just talk a bit about like what is the most attractive to a family office for the independent sponsor deal, and maybe just that DNA of like what the best structures are that you see.
I think, if you pull back the lens a little bit, from the sponsor perspective, in its simplest form, we see capital sort of come in one of two ways. And in some deals, usually in the example here would be almost where there's like a control private equity buyout group that does direct deals and also backs independent sponsors. They are probably going to take over that deal, right? They're going to take over control of the board. They're going to want to drive much of the process, and the independent sponsor is somewhat along for the ride. In the model that I think we're focused on a little bit more today, where whether it's an SBIC lender with family office capital or family offices with traditional lenders, whatever it might look like, I think it's much more of a collaborative approach, right? I think it depends if it's a family office that has done deals in that space, can add tremendous value and resources. Give you an example. I have a client that's doing a roll up in the for profit education space, and their family office partner has done well in that space and also has done really well in real estate. And so some of the deals we're working on now, we've added a sale leaseback component. The family office has great partners in that space. So it really depends upon the family office how active they want to be, or there's view that says, yeah, you know what, we don't really know this particular industry that well, but we really like the sponsor. We understand at a high level why this space is attractive. We love that you've gotten in this acquisition platform at an attractive multiple. So yeah, we want a board seat or we want observance, and we want to make sure we've got appropriate protections and minority rights. But if we trust you, the independent sponsor, maybe you have a bit of a track record either from that firm or a prior firm, sometimes they take a more passive role. There's no right or wrong answer. We've seen it both ways. In its most simplistic example, I would say, there's a very technical rule, which you probably never heard of, Adam. It's called the golden rule. He who brings the gold makes the rules, right? And so if, I need a $20 million equity check and you're handing me 19 and I'm raising 1 million of my own or friends and family, you're going to drive a lot of that process. If under that same example, I need 19 and it's coming from a third from an SBIC, another third from one family office, another third from my own investor group. Well, that's a different dynamic, right? And the governance and board might look a little different than that prior model. So we've seen all flavors of it, and it just kind of depends upon the particular deal.
Sounds good. Let's talk about the collaborative model between the parties a bit more. We haven't really talked much about the seller. the success I had closing, 14 SPs, 10 buyouts, 10 control deals, 8 larger buyouts, and 10 board of directors with $665 million of enterprise value, 75 LPs. It was a lot. And like none of that would have happened without the sellers getting involved.
Yep.
I also worked with investment bankers on the sell side as well, in RSM and Sage. And so it wasn't just free access deals without some banker protections and frictions and controls. So I was very fortunate to have a lot of deal flow, but also having been an investment banker and then also having some luck in picking the deal processes that were perhaps less competitive. But the thing with independent sponsors is that I think a majority of independent sponsors don't have any experience with buying a company independently, much less like really tangible experience dealing with founder or entrepreneur or family enterprise, actually deep relationship expertise with a seller. So like what do you see about that dynamic and how to make it easier for everybody involved? What dynamics and approach makes it easier for the seller to jump in and lean into the process, ultimately go through
Sure.
diligence, but then once they sign the LOI, which is an essential part of the process to have exclusivity, that's a really big step for the seller.
Yeah, and this is, I think one of the trickiest dynamics of every in a sponsor deal is I always tell our clients there's really three parties at the table, right? The seller, you, and the sponsor, and your capital partner, right? Who may or may not be at the table at that point in time. That's a very tricky dynamic when you and a sponsor are talking to a seller. Hey, you need to believe in me, my thesis. You need to believe that I'm going to bring let's say you don't know who that exact capital partner or partners, plural, is going to be. You're convincing that seller, hey, partner with me on this growth play, chips off the table. We're going to scale this thing together. It does take a leap of faith from the seller to buy that. In some deals, we know at LOI who that partner is going to be. There's sometimes they're named in the LOI or there's support letters or they're involved in early meetings. And other deals, we don't. We're signing an LOI and we're saying we're going to bring X to the table. We're going to support growth and we have to go find or solidify who that person is. And we may then, subsequent maybe 30 days plus or minus post LOI, we will often introduce the seller and capital partner to the seller and say, hey, great news. I found this family office. I found this SBIC. I found both of them. They're going to partner with me on this growth play. They want to meet you. I've told them great things about your business. I want you to meet them, make sure you're comfortable with them. So it comes together in different ways, but you're absolutely right. That dynamic, especially for relying on either a seller who's staying in the business, he or she has a really amazing management team, and we need them aligned with the vision. So trying to figure out when and how best to bring everyone together to make sure that share that same vision is critical to these transactions.
So we've covered a lot today. I think it's really important to think about the mentorship of the independent sponsor from the lawyers and the accountants, of course. Sometimes there's bankers, but the law firm and the role of the lawyer is super important. And the most important, I think, relationship between the independent sponsor and their entire transaction. So, John, maybe talk a bit about like what are you mentoring the independent sponsor, partner, client. Of course, there are complexities of that client relationship and the risk and the timing and the cost coverage, but really the mentorship role is critical. So, what do you pride yourself on personally and with Blips, as a firm? I think that's important and we'll wrap up from there.
Thank you. Yeah. I think, the beauty of this space is, first of all, you have to have a passion. I love helping these entrepreneurs who are many, if not all of them, could easily stay in private equity, investment banking, amazing executive roles at companies, but have decided to take a leap and launch and grow their own firms, which can be very rewarding professionally, maybe monetarily, but also comes with a lot of risk. So we're often a kind of a guided hand to say, hey, here's what we've seen. Here are the things you need, the blocking and tackling you need to do in the beginning of the next few months as you scale. You're not going to close on every transaction. There's going to be bumps. There's going to be hurdles. We're often there as part lawyer, part therapist, and saying, kind of hang in there. It's okay. You're going to get through this. Sometimes they go from launch their first deal in 6 months to 12 months. I've got one group who's taken almost 2 years to get their first deal. They've already closed on two this year, and they've got two more under LOI. They're probably going to close on four platforms in 1 year, which is amazing, right? So it takes a lot of persistence, like anything in life, and grit to get to that point. So we just try to be a thoughtful guide, provide pragmatic, thoughtful advice, make connections to our network, to folks like you, Adam, and others to say, hey, do you have the right accountants, other intermediaries, voices around the table? Do you need other introductions to whether it's capital or placement agents, whatever it might be? Because obviously, if they succeed, we succeed. So happy if any of your audience wants to reach out, whether they're family offices looking at doing more investing in this space, happy to brainstorm with them about what we're seeing, what works, what doesn't work. Or if there's other independent sponsors or those thinking of becoming independent sponsors who listen to this, happy to chat with them as well.
Great. It's been wonderful to have you here today in this topic. I've been looking to cover it for a year or so, and it's very relevant to, of course, my friends in the industry that are doing deals, but also the LP slash backer for these private companies, and of course, the opportunity to scale and create significant tax adjusted returns longer term. So, anything else you'd like to share to our audience about the industry? Any words of wisdom?
I think I've heard at a recent conference that somebody said it's a get rich slow scheme, but those who are thoughtful and pragmatic, you find the right investors, you find the right support team, you can have a lot of fun, help a lot of small sized businesses grow, which we all know are an important part of the economy. And yeah, Adam, thanks so much for having me on today. It's been a great discussion.
I like this. Thank you. I'm passionate of the space as well, and it's wonderful to talk about it, having been a part of the movement and a leader in the space in 2010s, and it's exciting to see it expand dramatically and get adoption as a concept, as a structure. I'd like to thank you for joining today, John Koeppel, in the Family Business Audiocast. Thank you also for our guest joining today. This is Artem Smith signing off. Please stay tuned for the next episode of the Family Business Audiocast.